Most people think getting rich is about finding the right stock, the perfect entry, the perfect timing, the next big opportunity. But Warren Buffett proved something else entirely. You don't need more ideas, you don't need more complexity, you don't need more movement. What you need are better rules. Because one good decision, repeated consistently over decades, can turn a small amount of money into something massive, something almost impossible to replicate if you keep restarting. Rule 1: Money is made in the waiting. Most people believe investing is about buying low and selling high, about being active, about taking profits, about moving quickly. But Buffett thinks differently. He buys, and then he waits. And that simple shift changes everything. In 1988, he invested around $1 billion into Coca-Cola, not a startup, not a hidden gem, just a simple company that everyone already knew. But what they missed was this: Coca-Cola didn't need to grow fast, it just needed to exist and keep selling. What happened next looks simple, but it's everything. That $1 billion stake grew to over $20, $25 billion over time. And more importantly, it didn't just grow in price. Every single year, Coca-Cola pays Berkshire Hathaway roughly $700, $800 million in dividends. That means Buffett is earning close to 70-80% per year on his original investment, every year without selling. The real insight is this: the big money is not in the buying, it's in the holding. If you're always selling, you're always starting over. Rule 2: Cheap can destroy you. Most beginners chase cheap stocks because it feels safe. Buffett did too. And it cost him. In the 1960s, he bought Berkshire Hathaway as a textile business. The company looked cheap, undervalued, a classic bargain, but the business was dying, and instead of compounding wealth, it trapped capital. Buffett ended up investing tens of millions of dollars into a business that produced almost no long-term return. If that same capital had been invested at even 10 to 15% annually, it could have turned into billions over time. That's the real loss. Not what he lost, but what he didn't gain. The lesson is brutally simple. A bad business doesn't just give low returns, it destroys time. Cheap is not a strategy, it's a trap. Rule 3: Buy great, not just good. After that mistake, Buffett changed. Influenced by Charlie Munger, he stopped chasing cheap and started chasing great. One of the earliest examples was See's Candies. Buffett bought it in 1972 for about $25 million. Now here's what makes this deal legendary. Over the decades, See's has generated more than $2 billion in cumulative pre-tax profits for Berkshire. That's roughly 80x return on the original purchase price, not from selling the company, but from the cash it produced. And the business required very little reinvestment, meaning most of that money could be used elsewhere. The insight is simple: great businesses don't just grow, they produce cash that fuels more growth. A great company will make you money, even if you do nothing. Rule 4: Use other people's money smartly. Buffett didn't just focus on picking investments, he focused on building a system. Through insurance companies like Geico, he gained access to float, money from customers that he could invest before paying claims. By the 2000s, Berkshire's insurance float had grown to over $50 billion, and today it's over $150 billion. And here's the key part: that capital often costs him close to 0%, sometimes even negative cost, meaning he gets billions to invest for free. If he earns just 10% annually on 100 plus billion, that's $10 billion per year generated from capital that isn't even his. The insight is clear: the best investors don't just invest money, they control flows of capital. If you control the capital, you control the game. Rule 5: Control yourself or lose everything. Most people think investing is about knowledge. Buffett knew it's about behavior. In 2008, during the financial crisis, when markets were collapsing, Buffett invested $5 billion into Goldman Sachs. But he didn't just buy stock. He structured the deal to receive 10% annual interest, meaning $500 million per year, plus warrants to buy stock at a discount. Over time, that deal alone generated billions in profit. Not because the market was easy, but because he acted when others froze. The insight is simple: the market transfers money from the emotional to the disciplined. If you can't control your emotions, you can't control your money. Buffett didn't win because he was perfect. He made mistakes, big ones, costly ones, but what made the difference is that he followed rules, simple rules, and he followed them for decades, and that's the part most people ignore. Because it's not hard to understand, it's hard to do. If you understand these rules, you don't need more information, you need more discipline, because wealth is not built by intelligence, it's built by behavior, repeated long enough.